You are a born skeptic, some might even say a cynic. You've built your career on questioning conventional wisdom, what people, what companies say. So when it comes to expectations for Trumponomics and the market under Donald Trump, what is the crowd perhaps getting wrong? What are they not seeing?
Well, I think that and I've been posting that I think the budget cuts are going to be a lot harder than people think. I mean, we're going after kind of the low-hanging fruit, both practically and politically right now, like the USAID stuff. But this is, and it is outrageous as some of the things that the DOGE committee is finding, and I agree that some of them are pretty silly. I think that materially, we're not really going to be able to do a lot until you get to kind of more serious items like Medicare, Medicaid, defense.
The third rail.
And yeah, the hot ticket third rail type stuff, and that's going to be much, much tougher. And so I think we're still in the early parts of sort of political theater on Trumponomics. And then, of course, we have the whole separate issue of tariffs.
And that gets me to the next question. I mean, you look at Trump's policies overall. They're both populist and, as you've described them, standard Republican. But so far, he's chosen to focus on trade war over, say, cutting taxes. So what does this tell you about Trumponomics in this second go-round rather than the first attempt?
Yeah, so, I mean, he obviously came right out of the gate with the tariffs over this past weekend that have been walked back temporarily. So it appears they're serious there. We'll see. The fact that Mexico and Canada kind of agreed to do things that they had already agreed to do. I mean, Mexico had 10 to 15,000 troops on its border going back to 2017 in a promise they made to Trump the first go-around and reiterated with Biden. So, again, how much is political theater? How much is real? We'll have to see. The China tariffs, I think, obviously are a lot more serious and are worth watching.
What's the economic risk?
Well, the economic risk, I mean, there's a couple of problems with the message, which is, well, if we charge enough tariffs, we really can eliminate things like the income tax and a lot of other sort of broad promises. And the fact of the matter is, I mean, tariffs, I think, brought in about $80 billion last year. And so, you know, in order for tariffs to replace the income tax, which is about $2 trillion of our $4 trillion in revenues, you got to have a lot of tariffs. Mm-hmm. So I don't think we're looking at that. I think the question is this being used as a national security cudgel as well as an economic cudgel, or is it strictly economics because they really believe they can raise a lot of money with tariffs? The numbers just kind of don't pencil out.
I am curious, though, when we talk about the potential overhang of this. I mean, I know, in fairness to the Trump administration, it's only been a couple of weeks here, but the idea that now Mexico and Canada have won a one-month reprieve, at least for investors and economic watchers, that's another month of uncertainty. Do you think we'll get more of a concrete policy, meaning an actual resolution of some form or another that will at least provide some certainty to the market? Whether the market likes it or not, that's a whole other conversation.
Yeah, well, I think drama is part of the message, Romaine. I mean, it was in the first administration. I don't see a whole lot different changing in this. I mean, the one thing you might at least point out in the past administration, for good or bad, I didn't have to check my X feed first thing in the morning to see what was coming out of the White House overnight. And so, we're back to a much more volatile set of political pronouncements and streams and walkbacks, and it's a little more uncertainty.
Well, how much confidence do you have in the people around Trump? Because Trump himself, we know he's just sort of this vortex, but there are some relatively competent people around him, including the Treasury Secretary, who you have some familiarity with back when you were running Kinnikos.
I trained him.
He was one of your first analysts out there.
He was my first analyst.
So you liked him then. Do you still like him now?
I like Scott Bessent an awful lot. We don't share the same politics, but he's a man of real character, and I think he was probably the best man for the job, given the political arena. So I'm hoping he does well. I think he will do well, hopefully, and I know he has the country's best interests at heart.
And you did see him, but you didn't actually get to talk to him about what he's doing right now.
Well, I was able to see him and congratulate him after he got the nod. So he's got his hands full.
You've described the last few years as the golden age of fraud, funny accounting, questionable behavior on the parts of investors, of companies. How would you describe where we are now, given that the lines between government and business are pretty much blurred, more intertwined than ever? You've got Elon Musk running Doge. You've got the president selling his own meme coin. You've got regulators perhaps taking their hands off the wheel completely.
Yeah, I'm hard pressed to think that we're going to see less of it in the near term. It sure seems like we're going to see more of it. Look, this is a cycle the likes of which I've never seen, and the willingness of people to believe things that just simply aren't true, it never ceases to amaze me, particularly as the cycle carries on, and the willingness of management teams now to project way into the future and make all kinds of claims and promises, I think is also sort of unprecedented. It's always been there, but it's greater now. You know, I've always said that bull markets place a premium on promises, and bear markets discount reality. And right now, there's lots of companies making lots of promises.
Lots of promises, but what is the reality? And I mean, and to Scarlett's point, you have some conflicts of interest in some of the folks who are, I don't know if they're in charge. I mean, they would say they're not in charge, but certainly sort of leading the charge in sort of trying to sort of root out whatever they think could potentially be bogging us down here. If you're not a friend of Elon Musk or a friend of Trump,
I think that's fair.
And you're running a company or an investment fund, should you be worried?
Yeah, I mean, I don't know. I don't know how personal it's all going to get to companies and individuals, but I am concerned that we have this whole new structure set up with people that are basically going in again. And if you read the president's executive order setting up the Doge Committee, which was an existing committee, the U.S. Digital Services Committee, it has no budgetary authority or even recommendations. It's set up as a technology and software consulting organization. Mm-hmm. So obviously the bailiwick has expanded to be something much greater than that. And the question will be, you know, will at some point a federal judge somewhere say, wait a minute, you know, this is, you're going beyond your purview, beyond your legal.
Does it undermine faith, though, in the system? I mean, particularly when I see people rooting around in the Treasury system. I mean, we can talk about USAID and some of these other things, but the Treasury, I mean, we're talking about the backbone of our economy, the backbone of our financial markets.
Structure. Yeah, I mean, we'll see. Yeah. And we'll see to the extent when it goes beyond just, you know, aerobic studies about shrimp in USAID and gets into, you know, Social Security and Medicaid payments and things like that. They're really serious. And then I think you're going to see, if there's any pushback, it's going to be pretty serious.
I want to shift our conversation now to the tariffs on China, which you said are going to be much more serious. The U.S. began imposing an additional 10% tariff on Chinese goods, and Beijing's response was targeted tariffs on about 80 products, which hardly seems like a proportional response. What does this reveal? Does this indicate that China has more to lose from a trade war with the U.S. than the other way around?
I mean, the argument for the administration is that they do, right? That China has much more to lose. They're a much more export-driven country. We'll have to see. I mean, I think China probably feels it was proportional, and we don't know what discussions are going on behind the scenes. So I think, again, wait and see. But I think that 10% isn't going to do it, by the way. I mean, getting back to our early conversation about the amount of tariffs you need to raise serious revenues, you know, you would have to raise them substantially on both China and the EU, and we haven't seen that yet. So we'll have to see what exactly comes within 30 days, 60 days. Does it escalate, or does it cool off? And it was an early campaign promise that he's delivered on, and now he's moved on to something else.
But at the same time, this comes at a precarious time for China's economy. You've been warning for a long time about China's debt bubble and its broken economic model. What does the imposition of tariffs, now at an additional 10%, but perhaps going even higher, mean for that long-term decline?
Yeah, it doesn't help it, that's for sure, because, I mean, China saw fewer reliance on net exports after 2010 when we first put out our warning, and that it's growing again. And part of that is due to the fact that the investment-driven model that we've been crying wolf about forever, albeit correctly, is losing its impetus to continue to grow. And the banking system is still bloated, and we've seen now problems in the residential real estate area completely trickle down into the actual developers. They've got a model that really now is facing kind of a crossroads with what they're going to do, and the U.S. putting on major tariffs to one of their few thriving parts of the engine, the export manufacturing area, isn't going to help.
Jim, we look at the market. It's now 3 months after the election, and the S&P 500 is up about 4%, just about 1% shy of its record high. Isn't it still just a big, long trade right now? How significantly different is the market under Trump than it was under Biden?
Well, I mean, it did pretty well under Biden. It did pretty well under Trump first go-around, too. So it's done pretty well under both administrations. And historically, the equity markets have done better under Democratic administrations than Republican administrations. Everyone kind of forgets that. But it's hard-pressed to see if you just look at the continuity of the last 8 or 9 years, or even going further back, where the elections were. Because, I mean, really, the market's done pretty well under all administrations. And
because it's done so well, there's little institutional appetite for short selling. And just over a year ago, you converted your hedge fund into a family office and an advisory because of that. We recently saw activist short seller Nate Anderson quit as well, shutting down Hindenburg Research. Is the traditional short selling strategy just dead now?
Well, I mean, so there's two different models there that you've referenced. The sort of traditional model that we employed for better part of 40 years, which was just simply putting on short positions, hedged or unhedged, for our clients who were looking for that exposure. And then there's the short activist model, which people like Nate and others have perfected or really done well with. And so I think it's almost two different questions. There is virtually very little appetite for a short-oriented fund product, even if it's hedged. Now, a lot of that is the advent of the so-called pod shops, the multi-manager shops, which have done a pretty good job of delivering returns with very little net exposure, which is what the long-short industry did for years and years and years. That changed. The long-short industry morphed into basically mostly long on the hedge fund side. But I think that I think there's always a market for insurance, as I've said. And remember that good fundamental short positions allow you to be more long. That's always been the point, that they allow you to finance your longs. So for us, it was passive, right? We bought the indices and had our short portfolio. And by the way, I mean, Bloomberg has a wonderful short index in its in the terminal, the Goldman Sachs Most Shorted Index. It's rebalanced monthly. If you looked at that since the GameStop episode, where everybody has basically said short selling is dead, you know, the risks are too high, and you simply shorted that index, bought the S&P or a related passive index, rebalanced monthly, that return has been spectacular. And so there's still alpha on the short side. It's just nobody thinks it's there anymore.
That's on a more of an index level. What about on an individual
stock
level?
That index is actually individual stocks.
It
the
is
most
individual
shorted,
stocks.
The most shorted stocks. It's a representative portfolio of very dicey companies, a lot of which we were short.
Well, but what's the risk out there? I mean, we talk about, I mean, we've sort of written all these headlines about the demise, and I know it's not completely dead, but we talk about, I mean, short bias funds down like 70% since the financial crisis, but even activist campaigns. I saw last year was like a record low, despite all the headlines that we got out all these companies like Starboard and a few others. It was a record low year for activist campaigns. Is that a reflection of market dynamics, or is that more of a reflection of public and political dynamics?
I think it's both. I mean, it's remember. I mean, the market prices are people's, facts, people's opinions based on facts, and so people have gotten much more bullish over general political level of regulation, the promises that companies made, and we talked about earlier. So, I mean, these are all part of a bull market. I mean, it's just the cycle has lasted a lot longer than a lot of people would have thought, including me. But I think that can change too, and so the problem is that price levels and where we are in that part of the cycle don't give you a good sense of timing. They do give you a good sense of how much risk you're taking should the timing change.
It feels like there's a lot of risk in this market right now. When you look at public market valuations, whether on an index level or an individual stock level, valuations are high. You look in technology, you go deeper into AI, the valuations are even higher.
Yeah.
Can you make a case that there
Speculation
is a bubble out there?
And speculation is there, Romain. Not quite as where it was in 2021, which
Right.
was the most speculative market I've seen. But it's getting back there. I mean, the speculation in meme coins, again, where just people are floating these
So
things.
you did not buy the Melania coin, is what you're telling us. Yeah.
I didn't buy the Enron coin that was floated yesterday, by the way. So there you go. So I think that these are all signs. And what we haven't seen yet, which we saw in 2021, but I suspect we will see soon, is a lot of issuance.